Hey, this is Chris, and in this video I'm going to be talking about the best way to invest for a passive income in Australia. Now, to give you some background, when you invest, there's two sources of how you can earn a return. So one is from the capital gain side, that's from share prices or other assets increasing in price over time, and the other is from income. This can be dividends from shares or distributions or other sorts of income from other assets. When they come together, that's your total return. Now, historically in Australia, there's been a big focus on the income side of things. People who like to buy things like bank shares and other assets with high income and have used that to try and give themselves a regular income stream from those dividends or distributions that they can live off. And in Australia, it's been possible because interest rates in Australia have been relatively high compared to the rest of the world, and shares in Australia have high payout ratios and high dividend yields, which means that they pay out a lot of their profits to shareholders, and ultimately shareholders can often live off those dividend profits. Now, unfortunately, for people who have historically lived off dividends in Australia, it's getting much harder to live off dividends, and the reason is the income yields of all sorts of assets, whether it's property or shares or bonds, have been falling, as have cash interest rates in Australia. And what that means is that assets like shares and bonds now hardly give you any sort of income return. Historically, if you wanted to give yourself, for instance, a 4% income return off an asset, you would be able to put 50% in a low-risk asset like bonds and 50% in a high-risk asset like shares. And those combined in Australia would give you 4%. But these days, in order to get a 4% income when you're investing, you need to put all of your money in shares. And so someone that's focused on making sure that they're earning a certain amount of income is going to be taking more and more risk in order to achieve that return, because you need to be yanking money out of safe assets like bonds and cash and plonking more of it into shares. Now, this isn't a strategy that I'd recommend. The reason is that the more money that you put into high yield assets or assets that have a high income return, the more risk you're taking, and ultimately when the market falls, you can wear a lot of losses. This was really acutely seen at the start of 2020 when high yield assets like bank shares and high yield debt and infrastructure shares and property shares all fell by somewhere between 30 and 50%. So someone that thought that they were earning a safe 4% return from these assets got a rude shock when the actual asset price itself fell by a much larger amount than the actual annual income you're getting from those assets. And this is why investing just for income is a pretty dangerous game to play, because you may have years where the capital stays positive, but you'll also have big drawdowns along the way. So what would I recommend instead? Well, there's a much safer strategy than investing purely for income, and that is actually having an investment strategy that focuses on your total return. That's the combination of your capital gains as well as your income. And this is a much safer strategy because what it means is that in your portfolio you have a range of different assets. You have some assets that generate high income, like dividend shares in Australia. You might also have some global shares that produce less income but have high capital gains. And then you'll have some safe defensive assets in your portfolio, like government bonds and gold, that actually produce little or no income return at all. But if markets fall, they might help to cushion the blow of those market falls. So you might be asking, well then, how do I actually earn my 4% dividend yield or whatever sort of yield you're after? And now if you have a total return focus, it changes. You can take part of your return from the dividends you're getting, but that may fall to probably 2 or 2.5% these days. And then what you're going to need to do is actually sell a little bit of your capital each year to recoup what you need from an income or passive income perspective. Now you might be worried, well, that's dipping into my capital, but what you need to think about with investing is that income and dividends are interchangeable. They're ultimately very much the same thing, and if you're taking from one, you're not taking from the other, and vice versa. So it doesn't really matter whether you're taking from income each year or capital growth. Ultimately, it would have been much smarter over the last few years to only take from capital growth, because assets that have performed very well have been ones like US tech shares that actually produce no dividends at all. They're investing entirely into growth. That's a good example of where only having capital growth would have been absolutely fine, because you could have sold a small amount each year. So in summary, when it comes to building a passive income strategy these days, I wouldn't be focusing on just buying assets with high income returns. It's a really dangerous strategy these days, and one that's going to probably disappoint you. Have a range of assets that have high income and low income, and you'll need to then start to withdraw a bit of income each year as well as a bit of capital if you need. It's going to give you a much smoother ride and make it a much safer investment for you.